Hello investors, thank you for joining me. In today's video, we're going to talk about Salesforce and whether Salesforce still offers investors any upside potential. Before we get started, if you're new to the channel, please subscribe now so you can get my next video installment. Also, if you're interested in the stocks that I own, I have a marketplace on Seeking Alpha where you can find the stocks that I own and why, with balanced arguments for all stocks, with pros and cons. So let's get started. Salesforce is being priced on the expectation that it's a stable business, that it's a predictable business. However, we can see that its latest guidance has come down, and I've been quite bearish on Salesforce, so it's kind of expected of me to be still bearish, but objectively I believe that you can see that there is a steady decline from it growing at approximately 25 to close to 30% how it finished its latest quarter just now, towards the end of the year. So the end of the year for fiscal 21, which is kind of ends in January, for fiscal 21, they're saying that their revenue guidance is approximately 17%. And if you look at how it breaks down, I've taken the top end, both for the guidance for Q2 and for the full year 21. I've taken top end. So all my figures are for the top end, just to put away any expectations that Salesforce is sandbagging their results. So you can see here when they beat the guidance just now by just 20 million, their revenue guidance came up as 31% year over year. Looking out to Q2, it's looking at approximately 23% at the top end. If you look at the current performance obligations that are outstanding, this is a leading indicator. You can see that for all intents and purposes, you can see a marked slowdown there too. So I assume that you follow Salesforce because you're very familiar with the company, but just as a brief reminder, one of the things that I've always said about Salesforce is that for them to keep growing at north of 20%, they need to be incredibly aggressive with their acquisitions. They have not really been able to be very strong on the organic side, so they're very much leaned on to acquisitions to grow their revenue, and anything below their revenue line, they've kind of either capitalized it or called it a one-off, or so they're on the adjusted side, below the revenue guidance line. It's quite dirty and it's difficult to discern, but hopefully after watching this video you get a bit more of an idea of what its underlying possibilities are. So here's one thing that I believe is quite insightful. So if you remember, Salesforce cash flow obviously doesn't include any accounting for stock-based compensation. This is their biggest cost in stock-based compensation. So even if you assume that the stock-based compensation is just a non-cash cost, it's not a material cost, you should not be concerned, although obviously you should be very, very concerned, because that over time that's those stocks get exercised and that dilutes the shareholder. But even if you pretend for the sake of the conversation that stock-based compensation is not a material aspect, you can still see that there's a marked decline from growing at approximately 25% year over year to growing at just 11%. Now, coming back to its revenue guidance, you can see that its revenue guidance for the first half is looking quite strong for Salesforce. For it to finish the year growing at 17%, it must be growing significantly slower in the second half of 2021. So maybe it's only growing in the second half at 10%. Now, a business that is growing at 10%, there are many of those businesses around, and they don't have the level of problems that Salesforce has, which I'll come to in a second. So if you take nothing else away from this presentation, is that there is a very consistent level here of cash flow generation spanning more than 4 years towards going to 2021 now, which is the year we're in, calendar finishing in January 21 is their fiscal year, there's a very marked acceleration. And what I really want to point to is that this level here is not just because of the Q1 where they had to deal with some kind of non-recurring cash expenses, such as the cancellation of their conference that they have in November. It's really for the whole year. That's what's important. Within its cash flow operations, one of the things that I have about Salesforce is what I will term, quote unquote, quite a dirty amount of cash generation. So you can see here that they have acquisitions that they make below the cash flow line. This is quite normal, it's accounting, but it still kind of points the question of what is clean free cash flow is going to be. So they have purchases of acquisitions here, and then they have sales here. So for this period, there's a net income, a net positive coming in, but other periods it exits. So it kind of just muddles up your expectations or your visibility into what its free cash flow can be. Similarly, you can see that when it calculates free cash flow, they only look at subtracting this number here. But then you have numerous business acquisitions that take place that bolster up next year's cash flow from operations, but in this year they come below the line here, so it's just kind of counted as a non-recurring event, but it's a very recurring event in this company. So these results are only for the Q1 quarter. It's a very short time frame, but you can just look back further as I'm doing now. So if you come to its 10K and you look here on the cash flow statement, you can see that it had that very large acquisition in the end of fiscal 19 and going into the next year, fiscal 20, that huge acquisition tableau right here. So you kind of have to consider below this line here how Salesforce is actually doing in terms of its cash flow generation. Moving on. The argument that many shareholders have is that Salesforce is a SaaS business, software as a service business, and it's being priced at a very low multiple to sales. So you can see here, it's by far the cheapest within the SaaS world. But it just you have to question what is really going into the revenue growth. If it's just acquiring businesses, its organic platforms are not so strong. Then you have to ask, well, how much cash flow could it hypothetically generate over the next 2 or 3 years? And if you look at its operating margins, even on the non-GAAP side, it doesn't look very attractive. Some of these businesses, I'm not by any stretch of the imagination bullish either ServiceNow or Atlassian, but you can see, okay, yeah, these businesses are growing organically, particularly this one here. This one, I mean, I'm not a fan of in any way, stretch or form, advocating for paying 30 times sales. That's just not what I do. But you can make the argument that this has a very organic platform. Salesforce does not have an organic platform, and its accounting is kind of a bit difficult to make sense of what an investor actually paying. So yes, on the surface, investors can make the claim that it's priced quite cheaply, but then again, what is really its capabilities in terms of generating stable cash flows from operations? We just saw at the beginning how its cash flows have gone when things hit the fan, how cash flows have gone from approximately 25%, and then when things turn a little bit sour, it's still priced at as if it's continuing on growing at 25%, where we know in fact, according to its latest guidance, that it's not. So I hope you found that video useful, and I'll see you soon.